Hi, everyone. We're live here in Highland Park at Meadow for Working Space. We are the Girl in the Home. I'm Juliana.
I'm Christine Craven. We're so happy to have you guys here. We know that we're gonna be able to share some really important information about how to manage your insurance claim process. Kelly Konzelman has 40 years of experience working with fire survivors, and we're glad that you're able to make it. So we'll let you take it from here, Kelly.
Thank you. Good afternoon, everyone. I appreciate you joining our workshop here. My name is Kelly Konzelman. My company is Reconstruction and Recovery Advisors. Want to say right in the front, I am not a lawyer and I am not a public adjuster. I am a licensed general contractor and work as a consulting contractor for people who have lost their homes in wildfires. My history is I have been building homes for survivors of insurance disaster for over 40 years. About 20 years of that has been working directly for the insurance companies as a licensed contractor. So if you had a fire or a flood or a major catastrophe at your house, you would report your claim. Your adjuster would call me. I would go out there, look at the site, inspect the damages, create an estimate, negotiate that estimate with the insurance company, and then if you would like us to, we would do the work for you. And that way we work directly for the insurance companies. I turned the tables on the insurance companies about 20 years ago, and we have started working directly for the insureds as from the homeowners, representing them and their interests. And my company, Reconstruction and Recovery Advisors, has probably assisted and aided over 300 families over the past 8-10 years to negotiate their insurance company claims, help them determine what the critical path is towards getting a settlement and moving forward. And the most important and critical thing is to how to get your house rebuilt and stay on timeline and work with your contractor. We're going to have an opportunity to have a question and answer at the end of this session. So what I'm going to recommend that you do, since so many of you are on Zoom, is that you open up your chat box, and anytime you have a question, just write the question out, type it out in your chat, and one of the girls will be reading those at the end of the meeting. You might find that by the time we get there, your question may have already been answered or covered, but we'll spend as much time as you need to answer your questions and get you some one-on-one. Few things that we're going to talk about today is understanding your policy limits, and your coverage, dealing with your adjuster and your carrier, how to get your carrier to pay your policy limits, very important, what to do to get your lot cleared and ready for reconstruction, mistakes that you don't want to make, and finally, some question and answer opportunities. So let's talk about your insurance policy for just a second. We're going to give you an example of a policy that is pretty typical, although the numbers will vary from person to person and from policy to policy. But in this policy, we have a $600,000 face value under your dwelling portion of your policy. What is your dwelling portion? It's the portion that covers your actual home, your residence where you live in. It's not your detached garages or driveways or your swimming pool or your fences. Those are covered under this portion called other structures. There's also extended coverage. That is coverage that is in addition to your dwelling coverage in the event of a catastrophic event like we just experienced. When your total loss exceeds your policy limits, there is additional coverage. In this case, most policies are about 25% that provides additional coverage for you. Personal property is your property that you own, your furniture, your jewelry, your clothing, your dishes and plates, and everything that's contained within your house on a personal nature to you is considered personal property. And then finally, we have loss of use. And loss of use is the part of your policy which provides day-to-day living expenses and reimbursement for those expenses as they are incurred through the period of your loss until you recover. You may have heard the expression, I have a replacement cost insurance policy. This is a very, very confusing expression, because when people hear that, they believe improperly that that means that whatever it takes to rebuild my house for, I am insured. And that is an incorrect assumption. A replacement cost insurance policy only relates to the fact that you are entitled to any depreciation that is withheld by the insurance company on your claim until you actually replace those items. So replacement cost coverage is different than guaranteeing the replacement cost of your home. The language in the policy is different, and it acts very differently. There are other optional coverages. Building code upgrade coverage is coverage that allows you to pay for the additional cost of bringing your existing structure up to current building codes. What does that include? Well, many of the homes that we have here in Altadena were built in the 1920s, 1930s. They don't have any seismic hold downs. They have no shear panels. They have no earthquake protection. The cost to bring your new house up to earthquake standards is included under your building code upgrades. It's also going to pay for the cost of putting fire sprinklers in your house and solar panels on your roof, up to the policy limits, which are typically 10% to 25% of your policy value. And finally, we have the last note, which is debris removal. Debris removal is typically 10% of your policy value. In this case, this hypothetical instance, it's $60,000. This is the amount that you have to remove debris from your building site. This is how your policies work. All of these coverages are not, you are not entitled to all of these policy limits just because your house burned down. The two that we really want to focus on is the second one, extended coverage, which is in red, and building code upgrades, which is also in red. The reason why those two parts of your policy are only covered as incurred. What does that mean? It means that as soon as you spend your first $600,000 rebuilding your house, every dollar after that, up to, in this case, $150,000, is reimbursed to you by your insurance company, but you have to spend the money first, or you have to encumber yourself by writing a contract to a builder for that amount of money before you are entitled to your policy limits under your extended coverage, extended dwelling coverage. The same goes with building code upgrades. These are not money that's paid to you up front. This is money that's paid to you as it is incurred. Both of these items, in order to really capitalize on getting your insurance company to pay for that, really requires a proper estimate valuation in order to value the replacement cost of the house that you lost. And this is really what is the crux of creating, of helping you with your insurance settlement. The insurance company does not care what house you rebuild. They don't care what color it is, what size, shape, or style it is. They are concerned with one thing. What is the value of the house that you lost? Because that is what you are entitled to receive from them in proceeds up to your policy limits. And that is what they are obligated to pay you for. So part of getting your policy limits here has to do with proving to your insurance company that the cost to rebuild the house that you lost as it existed and was finished on the day of the fire meets or exceeds your dwelling limits, possibly even your extended coverage limits as well, possibly even that along with your other structures and your building code upgrades. It may exceed all of those. But in order to get your adjuster to actually pay those amounts or commit to pay them, you may have to provide a detailed line item estimate, which proves to the insurance company that they have the obligation to pay for those costs, even though you have not yet rebuilt the house yet. I'm going to regress one bit. Extended coverage and building upgrade coverage is paid as incurred. We mentioned that. That means that you are not going to get a check for the amount of your extended dwelling or for your building code upgrades up front. But what is very important is that you get a commitment from the adjuster that they will pay those policy amounts in full prior to you signing a contract with the builder, because you are going to need to know how much insurance proceeds you have to work with, and you're going to need a commitment from the insurance company as to how much they are going to pay in the end, so that you know, do I have to go into my pocket? Do I need to get a construction loan? What do I need to do to fill the difference, the gap between what where my insurance ends and my contractor's, estimate ends? So the important thing is to be able to get the commitment from the insurance company that, yes, we are committing to pay your policy limits for building code upgrades and extended coverage. And sometimes they will do that without a line item estimate. But most of the time they will say, well, until you prove to us that we owe you that money, we are not going to commit to paying you the policy limits in those two categories. And that's where myself as a consultant can help you on your valuations. Debris removal, we're going to talk about for a second. This is important. In your policy, you probably have about 10% of your face value allowed for debris removal. Debris removal is actually the removal of the remaining debris from the property. It's the actual cartage away to the dump. It's not the demolition of that. It's just the cartage of it. It's called the removal portion. And it is a fixed number. You will find that there's two options that you have when it comes to cleaning your lot and taking advantage of this portion of your policy. The first option is you can do the lot clearing yourself. You can hire a private contractor to remove all of the damaged material, all the debris, and haul it off. But that contractor is going to have to provide a certification that there is no additional hazardous materials that exist on that site. So right now on your site, you've got an older house. It may have lead paint. It may have asbestos. It may have other contaminants. If there was cars that were parked in the garage or driveway that burned, there might be oil, there might be gas, there might be paint that was stored in the garage that leaches into the soil. The state is very concerned that we don't cause a major widespread area contamination. And that's why they want to make sure that your lot is remediated appropriately and properly by a licensed contractor. That work is very expensive to do, especially when it comes to hauling away this debris, because now it's considered contaminated waste. You just can't take it to the dump and dump it like if you were doing a remodel. The entire site is now contaminated. So the state is going to provide you the opportunity to opt in to a program with the either the Army Corps of Engineers or an agency called Cal OES. And Cal OES is the agency that's responsible for going in and clearing these lots for the community. And they do it for whatever the total proceeds of your debris removal is in your insurance. So even if it costs them $100,000 and you only have $10,000 worth of insurance for debris removal in your policy, you are only liable to pay the $10,000, and they will bill your insurance company directly for that. Any cost over and above that is borne by the state or the federal government. That is a very good program to avail yourself in, but it's a two-edged sword. Number one, we don't know, and you will not know when that lot is going to be cleared. Right now, they're quoting anywhere between 6 months to 18 months. And you don't know where you are in the line. You don't know where you are in the process. You just kind of have to wait and abide until you're notified by the abatement contractor that your number's up. So one problem is time delay. We don't know when that's going to occur. The other is the debris or the debris removal companies, they get paid by the ton. So they're inclined to take as much heavy things off of the site as possible. Foundations, concrete, driveways, walkways, retaining walls. Sometimes those things that exist on your property are salvageable and can be reused. Not always, but sometimes they are. So it's important that you understand whether or not you have foundations or footings on your house that could be possibly reused, because so many of our neighbors are underinsured. The ability to reuse existing foundations or footings could be very valuable if they are repairable, or they can be retrofitted to bring them to current earthquake standards. Some of them can't; they just need to be ripped out. So it's a decision that you need to make as to, are you going to use Cal OES to clear your lot, or are you going to use a private contractor? The private contractor might be faster, but it's not going to be cheaper, because it's something you're going to have to pay out of the proceeds of your dwelling portion for that demolition to occur, because most likely the debris removal itself, the cartage off the site, is going to exceed the amount of your policy limits. Let's talk about dealing with your adjuster and dealing with your insurance company. Most of you will probably have been contacted by an adjuster from your carrier at this point in time. You should expect that you're going to have at least 2 adjusters through this period. You may have multiple ones, because sometimes the file gets passed on down the line to multiple people. But the first person you're probably going to be dealing with is a field adjuster. His job is to inspect the site, measure the property, and work either with a contractor or by himself to come up with a valuation of what it's going to cost to replace your house. Remember that these adjusters are not building contractors. They do not understand the nuts and bolts of how to rebuild a house from scratch. Rebuilding a house from scratch is very different than doing a repair of a kitchen that caught on fire or a roof that was partially damaged. Building a house from scratch is a very different story. A lot of moving parts to do that, and your adjuster is not going to know the ins and outs of that. Also, a lot of these adjusters are third-party companies. They are hired from third-party adjusting companies. This adjuster might be from Tennessee or from Florida or from Ohio or from Texas, Oklahoma, place who has very low construction costs, not familiar with California building, earthquake standards, energy standards. You know, one thing about California, it's a nice place to live, but we have a whole heck of a lot of regulation when it comes to rebuilding. And these adjusters don't know it, aren't expected to know it, and will not include those costs necessarily in their estimates to rebuild your house. And that's why it's so important to properly value the house that you lost, because that's really the key to locking in your settlement with your insurance company. So the first person is your field adjuster. Once he finishes his initial work, which is probably doing an initial evaluation of your claim, he'll probably request a good faith check for you for various portions of your policy that state law says that they have to pay. Usually it's 30% of your dwelling portion, also a percentage of your personal property, possibly some on your loss of use. They will give you a check or request a check be cut. But after they get through that process, pretty much they hand the file off to a in-house adjuster who might be most likely is in a completely different state. This person is going to be one of the lower trained people on the totem pole here. Their job is to manipulate paperwork, contracts, agreements, policies, and they kind of act as the coordinator. That desk adjuster usually has to take the file, pencil out the claim and the settlement that's proposed, and then sell that up to their boss. And so it's a process, and that you might go through 1, 2, 3 desk adjusters over a period of time, over even if it's years, you might not be dealing with the same person day after day after day. But the insurance company's interest is this. They want to settle your claim as inexpensively to them as possible. So the way that you get your policy limits paid is by proving to them that they have the obligation to pay you, that you are entitled to these proceeds because you've been able to prove that the replacement cost of the house that you lost is equal to or exceeds the policy limits in your policy. If you do that, you have a very good chance of being able to negotiate yourself your policy limits. If they hold you back, especially things like on building code upgrades. I just had a meeting with a client today. They had $160,000 available for building code upgrade coverage. And I said, you really need to understand how to take advantage of that, because the insurance company is not going to give you any value on building code upgrades in their estimate because they don't do it. First of all, they don't understand it. They're not going to give an opinion on it. And they don't really know what the building code obligations are. So there's money in that policy that if you're not telling them what those building codes are and valuing those building codes, you're going to leave money on the table until the point that you rebuild, and maybe your contractor can kind of negotiate some of that back. But that doesn't help you in establishing the total value of your claim, so you know what your budget is when you're rebuilding. You really want to establish what that budget is by getting the insurance company to commit to the maximum amount of money in your policy. Mistakes that you don't want to make. Mistakes that you can make right now that are expensive and hard to erase and hard to go back on. The first is spending any money for consultants, public adjusters, lawyers, until you absolutely have a need to do that. Lawyers fulfill a role in this, but they are not necessarily needed in order for you to negotiate a settlement on your claim. Lawyers could be very helpful if like Edison Company is found liable for this fire, you by all means would want to hire a lawyer to help represent you in your claim against Edison. What's that claim going to be? The claim is going to be the difference, the difference between what your insurance premium, your insurance policy limits are, and your actual amount of your loss. Whatever that difference is, the difference between building your house and what you're insured for, that difference is recoverable. Also, pain and suffering is recoverable as a portion of that. Loss of any uninsured loss where you had furs or watches or jewelry that exceeded your policy limits, anything like that, those coverages would be handled in third-party litigation, and that's the best use of an attorney. But what you don't want to do is use an attorney or a public adjuster to help you at this early point in your time, because what you're going to end up doing is obligating yourself to deliver somewhere between 10 and 30% of the money that you need to rebuild your house to a professional who you may not need. And so we do not recommend that you do that until you get stuck. And there's better ways. I'm careful. Public adjusters can serve a purpose and a role. There are some good ones, but there are a lot of really bad ones. As a insurance specialist, I look at that personally as a predatory industry. Be very, very careful about retaining a public adjuster. They will charge 10% to 15% of your entire claim. So in this case, this claim here, they have total policy limits of $1.15 million, almost $1.2 million in this example. If they took 10% of that, that's $120,000 for doing nothing more than hiring a guy like me to write an estimate and sending it back and forth to the adjuster. It's a few hour. I don't want to minimize how the work, but it's nowhere near in comparison to what you are being asked to pay. And they take their position, they take their 10% on your personal property, on your loss of use, on all across your policy. Whatever you get paid, they get 10% of it. So it's not a good value. We don't recommend that. If you get stuck on your claim, we offer a service as advisors where we come in, we sit down with you, we look at your claim, we evaluate it, we look at all your lawyer's letter, or no, your adjuster's letters, any correspondence you have, any estimates that they may have provided you. We take a look at it. We say, okay, we believe that this is what you need to do in order to go forward. We do it as a free service. We do not charge for that service. If you need additional help, like having a line item estimate written, we can do that. That's where we make a fee, but we don't charge at all for advisory services. So that's one thing. Even after this meeting, anyone who wants to have a one-on-one consultation with me, I will sit down with you. I will spend as much time as needed to go over your policy, explain the whole process of how the claim process works, help you draft a critical path, and there is no charge for that service. This is something I do for the community as part of my give back. And if I have a service that you need and you would like to avail yourself of that, we talk about that separately. But there's much better options than hiring an attorney or a public adjuster, because you could pay, it's not even comparison what the cost differences are. Other mistakes to make are, some people are told by their adjuster they have to go out and get a contractor's estimate right away to rebuild their house. And usually that contractor's estimate is to rebuild a new house, which may or may not be similar to the house that you lost. You were living in a little Spanish bungalow, but now I want to do a contemporary house, or I want to build one with an ADU, or I want to put a second story on, or I just want to change the configuration or the style. You have your right to do that. But if you start on the process of hiring a contractor, signing a contract, or even starting with an architect to start designing a house before you know what your budget is, that's going to be a mistake. And I can't tell you how many times I've helped people 3, 4, 5, 6 months into the process where they've already got these plans and engineering done on a house, only to find out that they haven't settled their claim yet, and they don't have enough money to build that house that they just spent $50,000 to design. Then they have to come back and they have to redesign the house, pay those fees all over again. All that money is wasted. So be very careful. Don't spend money on design and engineering until you know what your budget is. Then you could work with your builder to say, okay, what can I build for this? And you work with your architect and your builder together to say, this is my budget, this is my build budget. What can we build together for this? How can it be fit and finished? So in a way that I don't have to come out of money out of my pocket. There is, for those people who find themselves underinsured, there's one avenue that will greatly help you to recover and build your house. And that is a loan program that's available by the SBA, the Small Business Administration. They will make loans of up to $500,000 to wildfire victims. And the interest rate on that, it's a 30-year loan. It's a second trust deed, essentially, on your property. And the interest rate is 2.67%. So as opposed to going out and getting a construction loan where the interest rate is going to be 10% or more plus points, it's better to borrow the money from the SBA. We even are recommending to borrow it anyways, even if you don't need it. Borrow the money at 2.67%. Take that money, pay down your more expensive mortgage, which is at 4, 5, 6, 7, 8%, whatever it might be at. Reduce that mortgage down, and now you're paying back expensive money with cheap money. And that money is available from the SBA. You still have to qualify for it. There's still debt to income ratios that need to be maintained, but that money is there to help people bridge the gap between where their insurance ends and where the actual cost of construction ends. One last thing I'm going to talk about, and that is valuation estimates. A valuation estimate is really important because it establishes clearly and concisely the cost to rebuild the house that you lost. And it is a skill set to do this. If you were to go and ask a typical builder to give me an estimate to rebuild the house I lost, they're going to look at you. They don't know where to start, but there is a process to do that. And there's a software system which we use that's used in the industry exclusively. It's called Xactimate. And you're going to see this in your chat rooms and things. Or what is Xactimate? What is it? It is a software program that is the industry standard system that's used by all the insurance companies and all the insurance restoration contractors. The software itself is exceptional. It does a wonderful job in helping value the replacement or rebuilding costs or repair costs of a home that was damaged in a claim. And the software contains about 12,000 codes with unit prices for everything from drywall to baseboard to doors to draperies to blinds to toilets to fixtures, and of all different quality levels. And what that allows a builder to do is to go in and write an estimate for the insurance company where the pricing has already been established and agreed upon by the insurance company. So the insurance company uses these published unit prices, and those prices are updated every month by Xactimate company to reflect the current market conditions on a zip code by zip code basis all across the United States. So when we write our estimates, what we do is we use that software and their unit pricing to create our estimates. So when we present our estimates to the insurance company, number one, it's written using their software and it's using their unit prices. So we never have an argument about pricing, and we never have an argument about format, what the format of the insurance company wants to see their estimates in, because we're providing it to them in this line item format. What's in a line item estimate? This is a line item estimate we just did for a little 1,100 square foot house here in Altadena. The estimate has 561 line items, even though it was only a 2-bedroom house. And the cost all in, $858,000. This is also separated by coverage, dwelling, other structures, building code upgrades, landscaping. It's already broken down in the estimate, so the adjuster can see exactly where they are over or whether they are underinsured. You can see that too. Very important thing to have, because this is the format that your adjuster wants to see the estimates in. Most building contractors will give you an estimate, but it will be a trade total only. Cabinets, appliances, framing, drywall, electrical, fixtures. That's good. That's a start. But what it doesn't do is tell the adjuster what they're buying. How much, how many toilets, how much drywall, how many square feet of wood floor as opposed to marble floors that you have. That's what a line item estimate does. And when you produce an estimate like this, you can give it to the adjuster, and what it does is it proves the value of your reconstruction costs to a point where they can't rebuff it. First of all, because it's written by a contractor and a builder who understands the whole process of rebuilding from scratch, everything from the site work, bringing in new dirt, recompacting that, digging your utilities, digging the foundations, putting your retaining walls in. These are things that adjusters they don't know how to value. We do all this in our line item estimates. So it's a wonderful tool to help you settle your claim. In some cases it's needed, in some cases it's not needed. But that's one of the things that we can help you determine when we sit down and meet with you and see, what is it that your insurance company wants to see? What do they need to see? So that's kind of my overall presentation. I would love to take some questions, and we'll spend as much time as needed to talk about that. So anything you might have a question, I'm happy to help. Go on. Yes.
We had a question actually from a renter. The owner of their home is refusing to remediate their attic and HVAC, which is full of ash, because their insurance won't cover it. Are you able to help those who are experiencing that type of situation with their insurance company, or do you have any suggestions?
That's not something we can handle, because as builders, this is more of a legal question as to what that person's legal rights are to have a home that's restored to habitable conditions. If there is a dangerous situation where there's hazardous materials on site, there are companies that do testing, on-site testing, and they can come in and do surface analysis. They can also do an air testing to determine whether or not that there is a hazardous material that is going to affect you. And that person can then take those results and either bring them back to the landlord, hopefully to get remediation, or to a third party to get some kind of legal help. But that's more of a legal question than it is a insurance question.
We have another one too. I know you guys have experience with seeing the rebuild process in other cities where fires have happened. What has been the impact on the insurance market afterwards, and how does it influence people being able to obtain insurance?
Okay, so the insurance market in California is a disaster as it stands. It is actually a disaster nationwide. This is a national problem. It's just California is exceptionally hit hard because our reconstruction costs are so high in comparison to other areas. So we have wildfire risks here, we have earthquake risk here, but the Gulf states have hurricane risk, storm risk, tornado risk. So the Gulf states, California, Western states are suffering from the fact that the insurance carriers are pulling out of our state. They are leaving. I've lost 2 homeowners policies on my own house. I don't even live in a fire area, but I've lost 2 policies so far in the last 3 years. So the companies are pulling out. This fire event being of the nature that it is, they're talking potentially 350 to $500 billion worth of damage. I mean, this is significant. This is somehow going to force changes in the insurance industry, because we know we cannot go on like this. The insurance companies can't continue to take risks, to get hits like this, and people can't afford to go uninsured. That doesn't work. We have an obligation to. Most of us have mortgages, so we have to have insurance on our policies, on our homes. So we believe also the fact that there were a lot of very influential people in our communities that lost their houses. And whenever you have rich people losing homes, they can put a lot more political pressure on people than poor people who lose their homes. It's just the nature of the beast. So I think that we're going to see changes in the insurance market. But you will find that most likely, for the time being, you will have a very hard time reinsuring your house unless you go through the California Fair Plan, which already is it's not bankrupt, but it is not healthy, because they've had so many policies that they've issued, and they do not have the reserves to cover their exposure should there be another wildfire event like this. And what happens after they end up paying all these claims, we don't know what's going to happen to California Fair Plan. So the insurance market is upside down. There has to be a solution, because we all have mortgages and our banks are requiring us to have insurance. So there's got to be some kind of way that the politicians and the insurance companies and the insurance commissions and the consumer agencies work together to find solutions, but right now we don't know what those are.
Question first. Right. Nights. Yeah, hi guys. Can you hear me okay?
We can hear you.
Great. Thank you so much for doing this. It's so helpful. So I have maybe a couple easy questions and then maybe not so easy question.
Okay.
The first one is I have an adjuster. We've had a few conversations. The first thing that I'm like finding the discrepancy of between talking to my adjuster and talking to some other like real estate friends of mine is whether, okay, this seems silly, but the fridge, stove, washer, and dryer, are these things that go as line items when we're rebuilding the house, or is this considered personal property?
Any appliance that is not attached to the wall, like a washer or dryer, or a freestanding refrigerator, or a freestanding range, is considered personal property. If it is a cooktop that's built into the countertop, that is considered part of the structure of the home. So if it is detached, like a washer, dryer, refrigerator, those are personal property, not dwelling.
Okay, great. And then that makes sense. And then okay, so we had solar and batteries, which I understand is rebuilding costs because that was attached to the house. But we also had a gray water system and a water filter system that was like outside the house. What would we file those under? Would that be under rebuild cost or would it be personal property also?
Okay, so typically anything that is outside of the dwelling that is not directly attached to the dwelling could be considered other structures and covered under,
Okay.
but not necessarily. Like for instance, a water filtration system, a domestic system that provides water to the house, if it was as long as it was attached, even if it was outside the house on an outside wall, that could be considered under your dwelling portion. Your gray water system is probably going to be treated similar to the way that a septic system would be treated in a different market. And that is, it's considered other structure because it's the only thing that attaches to the house is by one single pipe, which is not considered it does not make it portion of a part of the dwelling. So most likely that would be covered under your other structures.
Okay, that's good to know. So so in talking about other structures, so so just so you know, so our house burned down completely. And then but we have fencing. So one side of the fence is gone. It was a wood fence that we built. And then there's chain link fence around two other boundaries of the house. And then fencing around the other side, but we're just assuming that it's all sort of a wash. It's all going to have to be torn down.
Okay.
We didn't build the other fences. We only built one wall. So when I'm talking to my adjuster about like this other structures coverage, how should I go about talking about what the valuations of those structures are?
So for fencing and for fencing that sits on a property line and shares a property line, your insurance company will typically pay half of the cost to replace that, assuming that your neighbor's fence, that this is a property that's shared with your neighbor. However, if the fencing is 100% on your property, and you could evidence that by taking a string line and putting it down the property line from the corner stakes, if it is on your property, it is now your property. It belongs to you. It would 100% of it would be payable under your insurance policy, and 0 would be the percent of your neighbor. Most people, when we write estimates for walls, walks, and fences, we include 100% of the existing fences as if it is your property. And then the adjuster will adjust it from there, whether they feel that it's 50-50 or we don't make that determination. But when it comes to actually rebuilding, we always recommend that you try to share those expenses with your neighbors and try to cut those costs down in half, and then actually have a shared fence, even if it was not a shared fence previously.
Okay. Oh yeah, that's so basically we would go forward as if the fences were completely on our property and inside the property line, and then when we actually do the rebuild, try to strike a deal with the neighbors so that we're actually sharing the costs
That would
on
be
the property
best
line.
way to do it. Now, your adjuster may automatically discount the fence 50%, assuming that it's all on your property. But if you can prove that it's on your property and it doesn't belong to your neighbor, then it's not a shared fence. If it's not off the property line, even by 3 inches, it's not your neighbor's fence. It's yours. It's on your property.
And then when we're like coming up with the costs of the fence, let's say we want it to be a different kind of fence that was existing there, you know, we should be giving them the costs of the fence that it would be to rebuild what we want and not what was there.
Oh, no, it's the opposite. They will pay,
Okay.
place the fence as it was. So a
As
portion
it was.
with chain link, and then it went to wood, and then it went to chain link again. You know, some of these older homes that you get an amalgam of different kind of fencing material. They will pay for what was there, and then it's up to you if you want to replace the fence as it was. You can do that patchwork fence. Most people simply take the allowance and put the fence in if they want wood or chain link, so that's all the same.
Okay. Now, okay, so my next question has to do with the settlement check. So we actually did receive a check from our insurance company to rebuild. We owe more than, like, we've only been in the house for 3 years, so the mortgage company still owns a big sizable chunk of the mortgage. So they were also on the check. So we had to sign and send it to our mortgage company. And now they're saying that we have to complete an estimate of the rebuild along with floor plans and blueprints of the interior and exterior of the rebuild. And that they are going to release 33% of the claim check to start rebuilding. And then after the first inspection, if 25% of the work has been completed, then another 25% of the remaining check will be extracted. And that goes until we're 80% done, and then they release the rest to us. My question is, well, I have 2 questions. So one, if we do want to rebuild the house in a different style, different size, like what you mentioned at the beginning of the talk, are we like transparent with the mortgage company about that and the insurance company, or do we just like go about as if we're building the house the way like, how do we navigate that?
So, okay, so your mortgage company needs to make sure that they're secured by the amount of the mortgage that is currently outstanding.
Yes.
So typically your mortgage company is legally they can claim or hold or custodialize an amount of the insurance proceeds equal to the amount that is owed on the mortgage. Okay, because that securitizes them, but they're not necessarily entitled to hold all of your money, which means that if you get paid in excess of what your mortgage is, you should be able to ask for that and put that in some kind of an interest-bearing account and you know, maintain control of that money. When it comes to rebuilding, you are going to need to show your mortgage company a contract from your builder that relates to a set of building plans. It could be any building plans. It doesn't necessarily need to be the house that you exactly as it was that you lost, but that will show that when that house is rebuilt, the house will be valued at more than what the mortgage is. So that shows that their interest remains secure. So you can build a smaller house or you can build a larger house. What you need to do is when you are structuring your payment schedule with your builder, you need to structure it in a way that you and the insurance company and the builder agree, and the mortgage company as well. All 4 people have to agree on how the money is going to be dispersed, because some of the money is the mortgage company is only going to be holding some of the money. They're not going to be holding all of the money. Some of it won't be paid until you actually incur those expenses. So the mortgage company is going to be getting money, the builder is going to be getting money, and the insurance company and the mortgage company don't want to be issuing checks every 3 weeks when your builder comes and says, okay, I'm ready for my next progress payment. So it's a matter of the 4 of you working together to agree. And it's really, the onus really is between you and the builder, how you negotiate how the progress payments go, and what the mortgage company needs to see as far as inspections on a regular basis to guarantee that that work has actually been completed before they release that amount of money. So it's something that can be negotiated, but it's really important that you determine what the payment structure is so that your builder doesn't get stuck running out of money. He's coming to you for his next progress payment, but you can't get it because you haven't got it from the insurance company, hasn't paid the mortgage company yet. And it needs to be orchestrated carefully. So I really recommend that you, your builder, your mortgage company, and your insurance company get all on the same page as to, number one, what are the documents that are going to be required by your mortgage company in order for them to start releasing money, and the process and timeline of that money as it's distributed to you and your builder.
Okay, that's really good to know. In that same topic, so I'd ask, how do you calculate what the percentage completed is? Like, what's that informed by? And they said it's informed by the adjuster's worksheet. When they're making that worksheet up, that's basically, they make that up by, like, what do they base that off of, their worksheet? And what do I need to, is there anything I should know about talking to my adjuster about that?
Yeah,
while he's making that worksheet?
so your adjuster is going to come up with an estimate of some form. And the way that most adjusters do is they use the same program that I use, Xactimate, but they do an abbreviated valuation. And the way that that the program allows them to do it, because they don't have the time to sit down with everybody and go over all the details of the house and spend 60 hours writing an estimate. They just don't do it. So what the program allows you to do is do an abbreviated estimate. You put the square footage in of the house, what type of roof it had, what kind of siding it had, stucco, siding, wood, what kind of floors did it have? Did it have tile, wood, plasters, drywall? So they put in these general assumptions related to the house, and the computer, the software creates like a virtual estimate, as if which is not accurate, but it looks like it's an actual estimate to rebuild your house, but it really isn't. It's just done by the algorithms, which is using averages from a million different claims and kind of combining them together. So that's what the adjuster is going to give you. Your mortgage company is going to release money, or your insurance company is going to release money based upon the actual settlement that you make with them, based upon the house, rebuilding the house that you lost. So let's just use this example we have where the insurance company has agreed to pay policy limits across the board. They're not going to be paying that extended dwelling coverage or the building code upgrade right away until you actually start constructing and start incurring those costs. In this case, every dollar over $600,000 is when they start paying additional money to the mortgage company. Then the mortgage company distributes that to your builder. So I'm sorry, it's a big circle here. I'm not trying to be circuitous, but it's a matter of your builder establishing what the scope of work is and what that payment covers. And typically you've got, like, for instance, your initial site work, your dirt work, your foundations, before you actually start building a house. Maybe that's one section of the job that gets paid first as soon as that's completed. The next time we have what's called a combined inspection, which is your framing inspection, your electrical, HVAC, and rough plumbing inspection. That's another kind of sorry, it's another way in which an accomplishment that can be valued and paid at that point. But but it really is going to be really it's going to be a lot up to your builder and how much capital your builder has to work with. If he's paying for this thing out of his pocket, he may want draws every 2 weeks, which your insurance company is not going to do. Or your mortgage company is not going to do. So you're going to have to really work that out. But the money will come once you prove to the insurance company that they owe you the money, they will release the next thing. But it's much easier if you agree up front when those payments are going to come, at what event, and who needs to be the person out there inspecting to see that those things have actually been occurred before they'll release the next bit of funds. I'm sorry, that's
Okay.
a long answer, but
No, that was great. It does make a lot of sense. Okay, I have one more question. I'm gonna stop monopolizing you. Okay, we were paying like an extra premium for like Home Protector Plus, which gives us access to 25% of that like original amount, right? That the insurance released to us. How do we how do we make sure that we get to use that money?
okay, so in order to do that, we're going to use our illustration up here on the wall. In this case, we have $600,000 worth of dwelling coverage, and we have 25% extended coverage, which is pretty typical for that extended dwelling coverage. It might be more, it might be less. In this case, that means that there's $750,000 available to rebuild this house, the dwelling portion of this house. You are not entitled to $1 of your extended coverage until you can prove to your carrier that the cost to rebuild your house is going to exceed $600,000. Once you prove to them that it's going to cost more than $600,000, which is your dwelling limits, that's when your extended dwelling coverage kicks in, and it is paid as incurred, which means it's a reimbursement. It's not money that you get paid in advance. You actually have to start incurring the cost. Now, some insurance companies will say you need to incur the cost simply by signing a contract which obligates you to incur those costs. Sometimes they say that's enough to establish that you've met the test of acquiring those proceeds. Some insurance companies will say no, you actually have to spend the money first, and then we will reimburse you. Which makes it more difficult because you may not have $150,000 to advance. Usually the insurance companies will do that in a period of stage payments. But still, if it's a reimbursement, that means either you or your contractor may have to do work and wait for the money from the insurance company if it's over your dwelling limits. But the best way to do it is to get a valuation estimate approved and agreed upon in advance by your insurance company and yourself, which stipulates very clearly that they cannot back out on what the true replacement cost of the house that you lost is. And in most cases, it will almost always exceed the total of your dwelling and your extended coverage and your building code ordinance as well.
Okay, and they're not going to be like, oh, well, you're building the house in a different way than what existed, so we don't have to pay you on that. They won't come.
That's the reason why they will do that if you don't give them an estimate to rebuild the house that you lost. If you only give them an estimate to rebuild the new house, in a different found, they're going to say, well, this isn't the same house, so we don't owe you the same amount of money. We're just going to pay your dwelling limits and, fight us on the rest. So that's why it's really important to negotiate your settlement first before you start building a new house. Know what they're obligated to pay. Get them to commit to it in writing. It's another thing. That's another thing. Always put all of your correspondence with your adjusters in writing. If you have a conversation on the phone, which they like to do because they don't want to put things in writing, follow it up with an email to that adjuster saying, I'm documenting this conversation we just had on this date where you stated this and this and this and this, and send it to them. Because if they don't send it back a correction and say, no, that's not what we agreed upon, you've now documented that you've had that conversation, even if they have not responded in writing. You basically put them on notice. If the claim gets stagnated or if for some reason it has to go to litigation, now you have a bad faith potential claim. If you have shown that you have provided everything that they need as far as documentation, you've asked them for written confirmation, they failed to provide that, and then they renege on their commitment orally, you now have a claim which could probably exceed your building claim as far as bad faith.
Interesting. Okay.
Let's go
So
on.
Another question we have on here is, how do you handle the increased cost of construction materials? Will the insurance be responsible for that?
Okay, so when it comes to the cost of construction, we have what's called a demand surge right now. That means that all the construction costs in this area are going to go up because there's not enough builders to build all the homes that are damaged. So basically, builders can get what they want when it comes to rebuilding costs. There will also possibly be costs associated with shortages of materials, although I don't really foresee that. We're in a pretty major area of Los Angeles County. There's not going to be material shortages, but there will be labor shortages, which will drive costs up. It will affect your cost of replacement. You will pay more during a demand surge than if you did this remodeling on your own in a non-wildfire environment. Will the insurance companies pay more? What Exactment will do is they will, over the next few months, slowly bring up their unit costs to try to reflect the additional costs that are incurred through a demand surge. Does it always represent fair market value? No. But remember that in this instance, in most cases, you need to consider yourself, most likely you are underinsured. So at this point, we're trying to get policy limits. And even if the demand surge caused insurance prices or reconstruction costs to double, it doesn't mean that your insurance company has any more obligation than paying up to your policy limits. So it's a bad scenario that you find yourself in, where your policy limits are fixed, but your construction costs can vary based upon demand surge, and there's really no way to protect yourself against it. It is what it is.
Another one, someone doesn't plan on rebuilding, may they obtain and use 100% of their policy limits to purchase a different home?
Yeah, okay, very good point. I always forget this. The insurance companies in the past demand that you rebuild your house in order to facilitate and entitle yourself to all of your coverages that are paid as incurred. The extended dwelling coverage, the building code upgrade coverage. State law came in after the Tubbs fire in Santa Rosa and said this: you do not have to rebuild your house in order to capture 100% of your entitled policy proceeds if you replace by purchase. So you can replace by reconstruction, or you can replace by purchase. That means someone who has lost their home can go out there. In this case, we have policy limits for structural repairs, $870,000. So in this case, there's $870,000 in this virtual policy that we have here to rebuild the house. So I don't want to rebuild my house. I don't want to wait 3 years to move back in. I don't want to go through the trouble. I'd rather just buy another house in a different community. It could be anywhere. It could be in a different state. It doesn't have to be in Pasadena, Altadena. It could be anywhere that you want. But if you're trying to get $870,000 worth of insurance proceeds, then you have to buy a house that it costs at least $870,000, because that is the replacement. You actually have to buy a house that's slightly more, because the insurance company is going to discount the value of the land that new house sits on, because you're not replacing. You still own the land over here on your old property. But it is a way that you could take the insurance proceeds and use it to buy a new house. And who does this really help? It really helps people who have equity in their homes, or no mortgages, or a lot of equity, because they don't have to pay off their mortgage. But if you have a high mortgage, and let's say you had $870,000 in coverage, but you had an $800,000 mortgage, it's not going to do you a whole lot of good, because you're only going to have $70,000 to use to buy a new house. Yes, you will still own the land, because you're going to have to, in order to get the money from the insurance, from the mortgage company, you're going to have to pay off your mortgage, and the balance of that can be used to purchase a new home. You will still own your land. And let's talk about that for a minute, because there will be a significant market for lots in this area by builders and developers who want to come in and start building custom homes for spec. This is a very, very good spec market. There's a demand for homes in this area. So the builders the people are already going to start, you're going to start seeing lots coming up on the market. This happened to us in I'll give you an example, in Santa Rosa. There was an entry-level community called Coffee Park. It was about 1,200 houses, mainly 2-bedroom and 3-bedroom entry-level homes, like 900 square feet to 1,200 square feet homes. Those houses prior to the fire, and the community was destroyed, 1,200 homes, every single one burned. Those homes were selling between $275,000 and $315,000 prior to the fire. 6 months after the fire, the lots were selling for $250,000. And the houses upon completion were selling for $650,000. So it was instant gentrification here in this community. Why? Because the cost of construction was so high, anyone buying those lots would have to spend a lot more money to put a new home in there. They have to sell that for a significant amount of money. So the entire community went from a $300,000 community to a $600,000 community overnight. And we watched this happen. And we weren't sure, are they going to be able to recover the cost of spending $250,000 in these little tiny lots? And sure enough, every single one sold, and every single one of them's got a new house on it, and everyone is valued at $600,000 to $700,000. So there's value in the lot that you have. There will be developers who will come in and want to buy those. And if you are in the position to pay off your mortgage, buy another house, use those proceeds, especially if you can use proceeds from the small SBA loans, that might give you a nice down payment on a new house somewhere else where you don't have to wait 2 to 3 years in order to recover. So that's an option. If you do that, by the way, there is a process. You still have to go through the process of valuing the house that you lost, because you have to settle your claim with your adjuster, and you have to get them to commit to a number. But once you have that, the day that you close escrow on that, you have essentially replaced the house, and the insurance company is responsible for paying all of their withheld as incurred items.
More questions?
Any other questions? Yes.
It was an Paradise Fire.
Mhm.
And it was in that scenario you described where they sold the lot, they took insurance money, and then they were hoping to, but the insurance penalized it or something like 25% because they didn't rebuild. But I'm assuming this law is now changed.
Yeah, if they didn't rebuild, they lost their 25% extended dwelling coverage. They either had to rebuild or they had to replace by purchase. If you do nothing, you're going to leave this and this on the table. You're not entitled to it if you just simply do nothing. So the best scenario is, even if you decide, look, I don't want to live in this environment anymore, or I've been traumatized in this environment, I can't come back here, my children are upset, I'm upset, you might want to seriously consider still building that house and selling that house, because if what you're going to do is you're going to end up leaving money on the table, which is what your insurance company is hoping that you do. They're hoping you don't rebuild, because then they're not responsible for paying all those as incurred coverage, which they only have to pay as if you rebuild or replace.
Something interesting happened recently. So he had a rental property that burned down in the fires. And insurance was quick to tell him that they would give him, I believe it was 1 or 2 years of rental income. But they didn't tell him in the beginning that they would take that out of his rebuilding costs. Is that a common thing?
On commercial policies, we call them commercial or multifamily policies, or properties that are rented out, non-owner occupied policies. Some of those policies are old single family dwelling policies that, you bought this house, you lived in it for a while, then you decide you're going to move out. In the meantime, you've got an insurance policy that's been in place for 5 years or 10 years, and it does not include rental reimbursement coverage. Okay, so some people may not have rental reimbursement coverage, even if they have a tenant, because the policy may have been issued initially as a single family. If you have a rental coverage where you have loss of, it's called loss of use, or in case of loss of rent, it's usually a separate category of coverage that is not in your reconstruction dwelling cost. Okay, it is a separate column of money called loss of use. In this case, we have one over here, 25% of the policy value. And that is paid to you for loss of your use or your tenant's use or your loss of rent for those. And they will pay it for a period of time, let's say 1 year or 2 years, until that is exhausted. But let's see, this is $150,000. Let's say your rent was $10,000 a month. It would give you 15 months. In 15 months, that would be exhausted, even though they give you 2 years of coverage. Once you've hit the policy limits, you've hit policy limits. You're not going to get any more from that. But it should not come from your dwelling, your rebuilding portion. It should come from the separate portion of your policy called loss of use.
Another question on Zoom. Is there any way that insurance companies would raise the amount of additional living expense coverage since they have all been extended by 2 years now?
No, the answer is unfortunately, you're going to, we need to face the fact that your insurance policy is a contract. And there are limits to that contract. Your insurance company has obligated themselves to pay these limits if you qualify for those limits, but they will not pay more than what they are contracted to do. Now, the state may ask them to extend the dwelling loss of use or outside living expenses for a extended period of time. They might say, okay, in your policy, it probably states that they will pay them for 12 months. That's pretty common. In a case of a catastrophic wildfire, they may extend that to 2 years. They might extend it to 3 years. But once you exhaust your policy limits, even if it's done in 6 months, there's no more money. So it doesn't matter if they've committed to extend it for 3 years. Once you've hit your policy limits, there's no more money. So that's all they're going to pay you.
And then another question is, can I use my insurance proceeds for temporary housing on my lot or to build an ADU while my primary home is being built?
Yes, the answer is, and this is something that that's a unique situation that has come up because we have new laws relating to the use of auxiliary dwelling units in California, and they are very liberal in the way that those laws are drafted. The governor also, Governor Newsom came in a few weeks ago and said that we are going to allow for temporary structures to be built on the burn lots and used for occupation by burn victims during the time that the recovery process occurs. So how does that work? Up in Paradise, it was interesting. Some people were able to purchase RVs or trailers that they brought on their lot. Instead of paying month to month for an apartment or housing, they were able to negotiate with the insurance company to use their loss of use proceeds to purchase a RV, which is considered temporary housing. Now, we like something better. There are manufactured homes, there are manufactured buildings that can be considered temporary structures, which can later be converted to permanent structures. So if you're interested in having, you have your 3-bedroom bungalow here, but you'd like to put an ADU on your property at some future time, you may be able to negotiate to purchase a temporary ADU in the form of a manufactured home, and which are available. And when I say manufactured home, meaning that these are factory built units and installed on a temporary foundation so that they meet the test of a temporary structure, and potentially use insurance proceeds to pay for those under your loss of use portion of your policy. it's going to have, you're gonna have to make it really clear with the adjuster. Everyone's got to agree upon on this for the insurance company to be able to give you those proceeds. But the advantage of that is, number one, you stay on your lot. Number two, you end up after the fact owning a ADU unit that now you only have to build a permanent foundation for, which is not too expensive. And you're using insurance proceeds to accomplish that, which otherwise would go to rent. You're paying somebody else. So it's a good option. One of the problems on small lots, though, is where are we going to put this ADU unit in a way that it's not going to interfere with the construction that's being done on the lot? And if we're going to use Cal OES to clear the lot, we may have to wait an extended period of time before this lot is cleared to the point where we could actually put a temporary unit on the lot. We don't know what that's going to be, but the idea would be to maximize your loss of use by, instead of paying rent, to actually pay it towards something that you would eventually own, which you would incur ownership of. But it has to be classified as temporary, and that can be done by simply having a manufactured home type structure and a temporary foundation, and it would probably meet the test. I'm not giving you a legal opinion on this, but it's definitely something that's negotiable.
One more question. If they buy a new house, can they use their additional living expense to pay rent to themselves or their mortgage?
You cannot pay yourself any money. If you're the beneficial owner of a property, you cannot use your loss of unit of rents to pay money to yourself. You can pay it to a family member. For instance, let's say you're staying with your parents. You're renting the two bedrooms from your parents and part of the garage. You can draft a rental agreement with them, and they can negotiate a fair market value for the use of that portion of the home. And you pay them rent every month. You write them a check, which they deposit. So you're actually creating a transaction. You show your rental agreement to your adjuster, and you show them the checks that are being paid, and that is completely reimbursable. So there's a way that could be done too, where you're not paying rent to a third party, but you can't pay it to yourself. If you own the property, you can't pay yourself.
Okay. I think that's all. Any other questions?
Again, I want to thank you all for your attention. I make myself available for one-on-one meetings, consultations at no cost, no obligation. I will sit down with you. I'll review your insurance policies. We can look at all your coverages. We can ask me questions regarding, recommendations for, how to build, how to go forward. If you need a critical path generated to get through your claim, what are the steps that you need to do? I'll help you create that as well. There's no obligation. If you find that you need additional services, like you need an evaluation estimate, we can talk what those services would be. Or if you would need a liaison to act as someone between yourself and your builder when you actually go to construction, someone who needs to, can evaluate the construction documents, the contract, make sure there's no holes or trapdoors in them, or serve as eyes for you in the field that would come in and inspect at certain points the workmanship, make sure that things are proper. Those are things that we can do as consulting contractors. We offer those services, and they're all based upon the amount of work that is being asked to do. So we're flexible, but we're here to help, and we're here to answer questions. And my phone is always open, my cell phone or my email address, which Juliana and Christine can provide for you. You have a question, pick up the phone, call me, says I heard your presentation online and I have a question, and I'll be happy to take that and answer it for you. So thank you so much, everybody. We appreciate your time and everything, and best wishes to you all.
Thank you.